I'm excited because this is probably one of the most important and most in-depth videos I've done in a long time, especially on a stock. I was recently with my family around Thanksgiving, and I have several people in my family that like to talk about financials and like to talk about cryptos and stocks. And I was talking to them about Tesla, asking if they thought this was a decent time to buy in or whether they were, staying away. And it kind of struck me as odd, the responses I got. And I think I hear this a lot from people because, to be honest, some people haven't looked into the financials in 6 months or a year. And the financials have changed a lot. The profits that Tesla has been making has changed a lot. A lot of the landscape in the stock market has changed a lot. And a lot of people haven't been keeping track with it, but they hear stuff on the news and they just assume that it's right. And I want to go through this video and talk to you about why Tesla is so valuable and why it is my largest stock position, why I like it so much. And of course, I'm not trying to tell you to buy or sell, but I would say that you need to do more research if you have not done this level of research so far. Stay through to the end because we'll be talking about so many important things that you can even take outside of Tesla and look at other companies and try to discern how valuable they are. There's a link to moomoo underneath the video in case you want some free stocks. Just start depositing on the platform. So the things that I was hearing from some of my family members, some of whom might be listening to this, one of the things they said is they don't like Elon. Honestly, that's just part of it. A lot of people don't like Elon. They think that he's overhyped, that there's an Elon price effect. Basically, if Elon's part of a company, people will buy. And you can find so many people that hate Elon online. And he is definitely someone that you either like or you dislike. He's someone that's brutally honest. He'll do whatever he wants for the most part. And sometimes that's good, sometimes that's bad. But from there, I also heard that Tesla is no longer alone in the electric race. So many people are worried that they're going to have market share taken away, that they are not going to be the dominant player because so many other traditional car manufacturers are getting into electric vehicles and starting to produce vehicles. So let's break some of that down. Let's take a look at some of the financials and talk about, are they really alone and where are these companies coming from? Are they doing well so far? So first of all, this is Tesla's financials. This is their quarterly. Let me just make myself a little bit smaller here. So they've been increasing revenue pretty quickly. Everyone probably expects that, right? Last quarter was their best quarter in terms of revenue. It was pretty much tied with their best quarter for EBITDA. They had a lot of free cash flow. When you look here, they had over $3.29 billion in cash flow, basically $3.3 billion in cash flow last quarter, which beat actually the other large car manufacturers. They beat Ford and they beat GM. They also, something that a lot of people don't look at is stock-based compensation. And a lot of the big tech companies, part of the reason that they can have pretty high earnings per share is because they are, and some of their lower expenses is because they dilute shareholders a lot. And I could go through that a little bit more today. I won't go through too much, but they dilute shareholders a significant amount. They have a lot of shares being issued all the time. And you might see it at like 30% or 50% of their cash flow. And you can see it's going up as quickly as cash flow for a lot of companies. However, you can see here, we actually saw it go down. They're keeping this pretty lean. Only about 10% or so of their overall cash flow is going to stock-based compensation. Is actually the ratio is about 1 to 10. And you can see their cash flow kind of exploding here over the last year. If we go to the annual here, you can see $3.5 billion for last year, in the entirety of last year, and then just this last quarter is $3.3 billion. Now, their earnings per share is also going up. You have to realize, too, at the same time, cash flow, free cash flow is the income minus OPEX and minus CAPEX, and they're investing a lot of money. This is after they've invested a lot of money into building more plants and scaling them up. You have to realize that they are spending a lot of money and they're still at $3.3 billion. They could be much more profitable if they just stopped growing. You can see this, how profitable they are and how well they're doing from this chart here. Their cash, their debt, their capital lease. You can see their cash is going up while their debts are going down. You can see their debt is barely anything now, $500 million. They could pay that in a month of free cash flow. So this is all quite impressive. You can see that the shares have been going up a little bit, but when you consider a stock buyback, which they said that they'd be open to, they'd actually go from inflationary in terms of shares outstanding or diluting shareholders to actually buying more shares back, and they'd actually become deflationary. I don't know if deflationary is the right term there, but they would actually not be inflating shareholders anymore. They'd actually be buying more shares back. And we can look at some of the other stuff here. They do have a very good return on capital employed, especially compared to other car companies. This is basically how much do you make on the money that you get. So it's great if you can grow, but if you're taking on a lot of debt or you're diluting shareholders and you're actually making less, or maybe even making just a few percent, the fact is it's not worth it. You can take $1 billion and you can grow and double your revenue if you're at, let's say, $100 million. But if it takes $1 billion to increase your revenue by $100 million, that's not very good. That would be a terrible return on capital employed. Compared to Tesla, which is on the last year around 26%, which is much higher than most car companies, actually all car companies, I believe, and up there with tech companies. And actually, it's growing significantly. It's been growing over the last couple of years. If you look here on the annual, it went from negative significantly, like negative 70%, then negative 14%, negative 8% to positive 15% last year. And again, that's just 2021. It's been growing this year as well. So we've looked at this company. A lot of people have a lot of gripes with it. They also think maybe the valuation is too high. But let's take a look at some of the other companies, and then we'll look at a lot of the other parts of the business that's really important, that is stuff that people don't really look into. This is GM. GM, their revenue has been pretty much sideways. You can see it's actually been going down since 2016 pretty significantly. I mean, we're talking about $166 billion to $127. That's $40 billion that they've lost out in revenue. Their EBITDA, pretty much sideways. Free cash flow is very hit or miss. Keep in mind, they did own part of Rivian, so sometimes that changes their earnings per share pretty drastically. They do have positive EPS, which is good, but you can also see that their debt is significant, and it's going up. When we look back at Tesla, their cash is going up significantly. When we look at GM, they have $75 billion in debt, and their cash is pretty much staying sideways. Their debt continues to go up. Their shares outstanding are going up slightly, but not too much. Their ratio of return on capital employed last year was 5%. And remember, we've talked about how Tesla over the last 12 months was at 26%. They don't return capital, so they're basically dead. I mean, they can take shareholders' money, they can continue to sell, but they can't really scale. And you can see that because they can't return capital. They also have about $5 billion in CapEx compared to Tesla, which is around $1.8 billion. And they have nothing in terms of R&D. It's not even showing up. They used to have more G&A, but now they don't. Tesla also used to be the same way. But again, they have no R&D, while Tesla is spending about, $1.8 billion on just CapEx, but $700 million in terms of R&D. So they could cut that off and make another $3 billion a year in cash flow if they stop putting so much into R&D. Like I said, they're trying to scale up factories and trying to research as aggressively as possible, and they're still making $3 billion a quarter in cash flow. That's crazy. So they are also paying a dividend, which is good for some people. For other people, they might be thinking, why isn't GM spending more money trying to research and develop? Why aren't they trying to develop electric vehicles? Why aren't they trying to get out a charging station network if they really believe that they're going to get into EVs? But let's move on to Ford. Ford is pretty similar, with the exception of a few different things. Revenue pretty much sideways, actually down a little bit over the last few years, you can see. And if we go back even further, back to, let's say, 2005, right, they're at 177 billion. Now they're at 136, pretty similar. Their EBITDA has been positive the last couple quarters. Their cash flow is actually positive. If we go back to GM, it's actually negative, I believe, on the last year. Actually, the last 5 or 6 years, they've been losing about $10 billion a year. in terms of cash flow. Ford is positive, but it's still not great. It's pretty much a sideways. EPS was positive last year. Net income was positive. Shares outstanding has pretty much been sideways. Cash has been looking a little bit better. They've been getting a little bit more cash, basically just shoring up some cash, it looks like, from their net income and from their free cash flow. Their debt is still, though, $88 billion compared to cash of about $50 billion, and they are paying a dividend as well. They don't have research and development, really, in terms of their expenses, and they're spending about $6.2 billion a year, so multiple times, again, what Tesla's spending. Now, I realize that they're bigger and they're selling more vehicles, but the fact is they are not nearly as profitable as Tesla is growing to be. At this run rate, Tesla will be more profitable than Ford and GM combined in terms of free cash flow. Their return on capital employed is also very low. Used to be about the cost of capital, around 8%, maybe a little bit higher, but it's back and forth. And then last one, let's take a look at Rivian. Rivian is an electric car company. Maybe they're different. Their revenue has been growing pretty quickly. It's easier to grow at that point just because it's a lot easier to grow a couple $100 million than it is a couple $100 billion. Obviously, you can't scale up like that. They are down 71% in the year. Free cash flow is negative, about $1.7 billion a quarter. So significant amount of outflows. EPS obviously negative, net income negative. Their cash is going down about 1.6 or 1.5 billion each quarter, which is pretty fast. I mean, just a year ago, they were at 18 billion. Then after 3 quarters, they're at 13.3 billion. So again, 5 billion over 3 quarters, probably around 6 or 7 billion for the year. Their debt isn't really going up. It's actually going down a little bit. It looks like they're just trying to pay off a little bit of debt. We're talking about tens of millions of dollars throughout the quarter, which maybe they're just taking some of their cash and then putting into that just so that they can say that they're paying down their debt, or maybe they just have to just because it does amortize over a certain period of time. Shares outstanding are going up just a little bit, not too bad for a new tech company. They have negative return on capital employed, which is what we saw with Tesla during the earlier years, and they are spending much more on research and development than a lot of the other car companies. Their capex is still relatively low, and they're actually spending less on it. So I'm not exactly sure how that's happening, but maybe they just aren't building as much. So overall, Rivian is in a pretty tough place just because it looks like in about 2 years they're going to have to dilute shareholders, or they're going to have to become profitable, or they're going to have to get some more debt. So they're very unprofitable right now, and it looks like it's actually ramping up as they're selling more and more vehicles. They're actually becoming less and less profitable. And we've heard that from some other car companies too, like GM and Ford. They're having a hard time actually making money on the vehicles. And why is this all happening? Why is Tesla so much more efficient? Why are they making so much more money? It's for a couple different reasons, and this is just a few. First of all, Tesla doesn't spend money on ads. Like GM and Ford, you see ads for them all the time. They don't spend money on ads. They also are just so far ahead in battery technology for the price. I mean, I saw a Lucid this last week, and it's beautiful. It's awesome. Long range too on it, supposedly. But the fact is, it is much more expensive. It either costs you, the consumer, or it costs them, the company, much more to get that kind of range. And so far, everything I've seen and heard, Tesla is far ahead in battery technology. Also, one other problem that I see is the fact that if these car companies want to become more electric vehicle oriented, like Tesla, they are going to have to build out a charging network. And Tesla's built a ton of chargers. They're the largest charging company in America. I don't know how these other car companies are going to be able to compete. When I talked to Lucid and the people at Lucid, they said that they use general charging. They have a general charger that can't be used with Tesla yet, they said, but they think that they'll gain access to Tesla's network. So I don't know if they're saying that just to try to push sales, because this is like the bottom tier, I suppose, in the Lucid company. It's people that work at a store. So it's not like they're hearing from the higher ups all the time, I assume. They are either trying to make more sales, or they're just giving up on the fact that they're going to have their own network. They're hoping that they get part of Tesla's, and Tesla might be able to make some money from that as well. These other car companies, I don't know how they're going to do it. They don't have the cash position. They have a lot of debt. I don't know if they have the know-how. It's expensive to buy the property and then also to install and then also to keep up with it. And I don't know if they have that ready. I don't know if they have that ready, the team's ready for that, or the technology or the money for that. And then also, Tesla doesn't have dealerships. One of my favorite YouTubers calls them stealerships. And the fact is, they make money. I think all of us probably know someone that owns a car dealership, and they make money hand over fist, whether it's a used car dealership or a new car dealership. The fact is, they take cuts. They make lots of money. They have lots of employees. They have a beautiful place to sell the vehicles, and the people that own the car dealership usually make hundreds of thousands, if not millions of dollars. That is taking away from the companies. I got done with the video and I realized that I need to add this in as another part of why Tesla is so lean. Let's take a look at Ford and GM's website. If you go to Ford, you can see they have a ton of different vehicles. They have SUVs and crossovers, like 8 different models. They have a ton of trucks, electrified vehicles, cars. Then they have their list of all vehicles that are even like vans and stuff like that. Go over to GM's and they're even bigger. I mean, they have Chevy, Buick, GMC, Cadillac, etc. And when you go to just GM's page, they have a list of trucks, a list of SUVs, Hummers, Denali's, AT4s, commercial, future vehicles. There's so many different vehicles. People have to realize that all these vehicles have different teams. Some of the stuff can be used, but a lot of these vehicles are expensive to continue to develop, to continue to change, and it just adds more complexity. Compare that to Tesla. They have 4 vehicles now. They're going to get the Cybertruck here soon. They have the Tesla Semi as well. So 6 vehicles if you count that. But they use a lot of the same parts. They use a lot of the same processes that they use in all the vehicles. Also, when you go to their investor presentation, they're also trying to cut down on the wasted time and waste just in their factories. And they don't have to use as many parts as they used to. I mean, when you think about this, right? Think about how many different parts they have for 60 different vehicles. But they have 6 vehicles, so less parts in that way. But they also have less parts because they're putting them all together. If you look here, they are trying to simplify the vehicle. So this is the Model 3 body structure, 171 pieces of metal highlighted. And Austin has now been making Model Ys. This is back almost a year ago now. 2 pieces of metal highlighted. So they have 1,600 fewer welds. Think about how much time that saves. Think about how much money that saves. Think about how many less materials they need. That is the kind of innovation that Tesla is using. And a lot of people think, oh no, they don't have enough vehicles. They're still having record sales. They're still selling out fine. I don't think people really care too much about having vehicles that are different from other people. Like whether you have a Model 3 or whether you have another vehicle like a GMC, and whether 1 million people have your vehicle in your state or 500,000 or 300,000. Does it really matter? Wouldn't you rather have something that's faster, safer, also better looking, cheaper than the other vehicles? I know I would. I mean, we don't really care about competition as much as we care, or we don't care about other people having the same things as we have, as much as we care about them being useful. I mean, think about Apple, right? Think about how many products they sell. A lot of people buy them, even though a lot of other people have them, because they're just so easy to use and they're so easy to integrate with. So I don't think that that's a good reason to buy something else or to downgrade Tesla because they have less vehicles. It's actually quite the opposite. It's much more efficient because of it. These other car companies don't have the advertising power. They don't have the demand. And while Tesla still hasn't sold that many vehicles yet compared to something like Ford or GM, the fact is they are still being sold out every single quarter. They still have not had any kind of demand problem. And while you might see backlogs decreasing, the fact is some people are waiting for the EV tax credit. It's something I didn't even put in here, but supposedly in the US we're going to have an EV tax credit that happens very soon, so they might be waiting for that $7,500 that they get from buying a Tesla. Another gripe that a lot of people have is that they think that Tesla makes a lot of their money from EV credits. If we look at last quarter, the EV maker generated $286 million from offloading carbon credits, which was 1.3% of the overall Q3 revenues of $21.45 billion. So they made 1% of the revenue from carbon credits. This is less than 10% of their free cash flow. And this is becoming less and less important. And as time goes on, it's just not going to be relevant anymore. $300 million in free cash flow for Tesla is just going to be a drop in the bucket. The other thing is, too, you could be saying that this shouldn't really count. But if I handed you $100 for recycling a can, I think you'd still be happy about that. It still helps you overall in life and in your finances. It doesn't really matter where the money comes from. You don't want to predict that forever, but you have to realize that there's going to be more initiatives to keep us transitioning to green energy, just like I was talking about with the EV credits for consumers. Tesla might have to increase their prices just because they have so much demand after that happens. Now, is the competition coming? Yes. There are a lot of car companies that are starting to make electric vehicles, but they have a lot of issues. Tesla had a lot of issues, and they worked at it for years and years before hitting production. And yes, the other car companies have been doing this for a long time, but they've also been failing at making electric vehicles for a long time. We've actually had electric vehicles for over 100 years. Isn't that crazy? But GM and Ford and all these other car companies are having a really hard time. GM is delaying its plan to build 400,000 EVs in North America. They had to push it back 6 months. Some articles say that there's a shortage of new EVs because of a global issue with supply chains. Well, Tesla is still being able to sell all the EVs that they're making, and they're making a lot more EVs than Ford and GM. Ford has had some recalls as well. They had 49,000 US Mach-E's, which I believe at the time was half of the ones that they've made over potential power loss. And these are significant. A lot of these different recalls have been significant and scary, like physical recalls. Now, Tesla's had a lot of recalls as well. A lot of people like to point this out. A lot of news organizations like to point this out. But the recalls have been over-the-air updates. I've had several of them. I've noticed a thing wrong with the car, and then a few days later, I get an update that it's been fixed, and I don't have to do anything with that. It's something that's fixed just like that. So they're able to save a lot of money because of this. They don't have to spend hundreds of millions of, not billions of dollars on recalls. So they're just a lot leaner. They're a lot smarter. They're a lot better at what they do than a lot of these other car companies. And they are continuing to set that trend. Now, how much are they actually selling? Maybe they'll become less profitable, I suppose. Or people think that it's just too expensive because they sell less vehicles than GM and Ford. And the fact is that they have a high valuation compared to GM and Ford, even though they're selling less. So I think that would be the wrong way to look at it. GM sold 6.3 million cars in 2021. Ford sold about 3.9 million in 2021. Toyota is around 10 million to 11 million every single year. So right now, Tesla is going to look at about 1.3 million or so, 1.4 million this year, trying to ramp up 50% a year. So they still have years and years to hit Ford size and GM size, but they're already as profitable as these companies. And it's not from tax credits. It's because they have a higher average selling price, more demand, and they are selling or being able to build them for less than these other car companies. So they're making a lot more money on the bottom line. I think that it will be surprising to a lot of people when they are years in the future and they're selling as many vehicles as GM and Ford. Maybe they have to start lowering the prices down a little bit, but it'll be surprising to people how much money they're making, because if you haven't heard about it, there's something called economies of scale. Basically, as you scale up, the costs become less and less. You don't need as many R&D teams if you're doing $10 billion versus $1 billion. If you're trying to build the same stuff, it doesn't really matter. You can spend the same amount. It's not as expensive to hire other people in your business, like accounting. It doesn't matter if they're accounting for, $10 billion or $20 billion, right? It's generally going to be the same. And just over time, it's easier to scale up and put more money to the bottom line as you scale. Margins improve. So that will be really interesting to see as well. some people just still have a problem with Tesla's overall market cap. Now, it's come down significantly throughout the year. When you look at the growth, though, a lot of companies are having growth revisions and they're having downgrades, and they're having more and more people bearish on the future because they're not showing good results. However, Tesla has executed really well. Their forward PE, according to analysts, is around 32 now. Now, I know companies that had no real growth, no real demand, that were at PEs of hundreds a couple of years ago or even a year ago. Even tech companies like Google have been around 20 to 30 over the last year. Tesla is growing 50% consistently, have high margins, have high free cash flow. This number, I think, is a little bit high as well. I think the forward PE is actually lower. Their growth estimate is not very significant for Tesla. And keep in mind, we had shutdowns during the summer in Shanghai that really affected Tesla. If that happened again, that would be bad. But it should help them a lot this coming year that they don't have that. Tesla has said that they expect revenue estimates or revenue growth just under 50%. Here we can see that they're expecting EPS to go up about 30% or so, not close to 50%. And you would think if Tesla grew revenue by about 50%, EPS should grow even faster because of economies of scale. So a lot of people expect Tesla to be closer to $6 to $7 per share, which would, if they were at $7 or $7.50, would put them closer to a 25 price to earnings ratio moving forward. Now, that is all just based on the car company. If you're buying Tesla, you also get some call options. First of all, they just completed their first 500-mile trip with a fully loaded Tesla semi-truck. That's going to be a big profit generator. And as they scale that, the thing is, it's going to save a lot of businesses money, and it's much less emotional than a consumer. If you can save, let's say, $100,000 a year, which electric vehicles should be able to save tons of money. If you can save $100,000 a year by having a Tesla Semi, why not buy it? There's no reason to. People are just about the bottom line. They're not worried about this and that. They just want to make sure that they make money from it and that it doesn't slow down their business. So 500-mile range, that's significant. They can still charge it pretty quickly. A lot of people are worried that Teslas can't charge quickly. I forgot the exact charging time. I think it's half an hour to 45 minutes on the Tesla Semi. But you need to take breaks as a truck driver anyway. So let's say you drove 300 miles. You drove 5 hours. You take lunch, you charge up 20 minutes, 30 minutes, then you go back out on the road for 5 more hours, and you do the same thing at dinner. So I talked about this being a call option. They have a lot of other call options. I mean, whether you believe in the robot or not, they are paying for this. They're doing research and development. They still have a ton of cash flow after it. Also, full self-driving is very close, it seems like. They just rolled this out, I believe, to all of the US or all of North America. I forget which. But they're going to start recognizing profit from this. If you didn't know this, they've been selling this, and right now it's $15,000 a vehicle. They've been selling this for a handful of years, and they gave some access to it, but they have been deferring the revenue. They have not recognized it at all. This is basically just going straight to the bottom line. Gary Black, someone that's highly invested in Tesla, believes that they will recognize one-time deferred revenue of about $1 billion in Q4 from FSD version 11. Now, as time goes on, they will probably recognize less as a percentage because right now they have about $2.8 billion as of last quarter in deferred revenue. It's probably going to be even higher, let's be honest, in Q4. A lot of people will be buying it. But $2.8 billion, they think they'll recognize about $1.1 billion, and then they'll recognize the rest over a number of years. Now, they said that they believe they have about 400,000 FSD packages that they've sold for an average of $9,000 since FSD became available. You have to realize as time goes on, people are going to be much more likely to buy FSD if they know they have access to FSD. It's a pretty hard pill to swallow to hear that you have to pay $15,000 for something when you don't know when you'll actually be able to use it. And that's where we're at now, that they do have the beta out now. So if you buy a Tesla or if you pay for the package, you can get access to that here in the US. So I think they'll have a lot of people start signing up for this. And of course, there are risks to Tesla. Let's be honest. There are a lot of risks, but I think that the upside outweighs the risks. There are so many things that people don't look at, that people don't understand, that people don't dig into. And I want to bring them to light here because Tesla is my top holding, and there's a reason for that. I think a lot of people don't realize the landscape, but they don't understand the upside for Tesla, and they don't understand how much better of a company and how much smarter they are. They're not a bloated, old, 100-year-old manufacturing company that has had the same revenue, actually declining revenues for 15 years. They are a growth beast with high margins that is getting better and better at what they do by the day. So I would pay attention to this. Of course, they could fall down in price, but at this point, I think that they are just a golden ticket, essentially, in the stock market compared to a lot of other car companies that are just dying and bloated. So let me know your thoughts on this underneath the video. I know I don't want to hold on to a company that stays stagnant for 10 years. Let me know if you do in the comment section. If you guys want some free stocks, there's a link to moomoo underneath the video where they will give you a ton of free stocks when you start depositing. And I'll see you in the next one. Bye.